Let me tell you about a man named Frank. Frank retired at 67 after 42 years as a project manager for a mid-sized manufacturing company in Ohio. He did everything right. He maxed out his 401k match for 30 years. He rolled over his old 401ks into IRS. He attended the retirement planning seminars his company offered. He thought he had it all figured out. Frank turned 73 this past June. He and his wife Mary planned a quiet celebration at their lake cabin. Grilled steaks, a bottle of wine, a card from their daughter that made Mary cry, a good night. Then, 3 months later, Frank opened a letter from the IRS. The letter said Frank owed a penalty, 25% of the amount he was supposed to withdraw from his retirement accounts, but did not. The number on that letter was just over $21,000. Frank sat down at the kitchen table and did not move for 10 minutes. Mary asked him what was wrong. He just handed her the letter, $21,000. For missing a deadline he did not even know existed. By the time Frank called his accountant, the damage was done. The missed distribution itself, nearly $85,000, would now count as taxable income for the year. He would owe income tax on it. His Medicare Part B premiums would go up next year because the income adjustment kicked in. And on top of all of that, the 25% penalty. Frank is not careless. Frank is not stupid. Frank is you. Frank is your neighbor. Frank is every retiree who spent a lifetime building a nest egg and never realized the IRS has a loaded gun pointed at it. The mistake Frank made is called a missed required minimum distribution, and it is one of the most expensive retirement account errors you can make without even realizing you made it. Today, I am going to walk you through every version of this mistake, exactly how the IRS penalizes you, how to avoid becoming Frank, and what to do right now if you are approaching the age where this rule kicks in. Let us start with the basics, because most people do not even know that the word minimum in required minimum distribution is doing a lot of heavy lifting. A required minimum distribution, or RMD, is exactly what it sounds like. The IRS requires you to withdraw a minimum amount of money from your tax, deferred retirement accounts once you reach a certain age. They let you defer taxes on that money for decades, but eventually they want their cut and they are not patient about it. The magic number is 73. Starting in 2023, the Secure 2.0 Act pushed the RMD age to 73. If you were born in 1951 or later, that is your trigger age. If you were born between 1949 and 1950, it is 72. And if you were born in 1960 or later, get ready, because your trigger age is 75. But for most people retiring right now, the number is 73. By April 1st of the year after you turn 73, you must take your first RMD. That is the deadline, not the end of the year, not when you feel like it. April 1st, after that. Every subsequent RMD must be taken by December 31st of each year. Miss that April 1st deadline, even by 1 day, and the IRS hits you with a penalty that starts at 25% of the amount you failed to withdraw. Let me put that in perspective. If your RMD for the year was $40,000 and you forgot to take it, you owe the IRS $10,000 in penalties, not in taxes, in penalties on top of the tax you will owe when you finally withdraw the money. And here is what makes it even worse. The penalty used to be 50%. The Secure 2.0 Act reduced it to 25%. And if you correct the error quickly, it can go down to 10%. But 25% is still a quarter of your distribution. That is not a slap on the wrist. That is a fractured hip. The IRS does not send you a reminder. Your financial advisor might not remind you. Your 401k plan administrator is not responsible for making sure you take your RMD. You are responsible, period. And this is where it gets complicated, because most people in their 70s have more than one retirement account. If you have worked more than one job over the course of your career, and most Americans have had something like 12 jobs by the time they retire, you might have a 401k from a company you left 20 years ago sitting in a forgotten account. You might have rolled an old 401k into a traditional IRA at a brokerage you stopped checking. You might have a SEP IRA from a side business you ran for a few years. Every one of these accounts has its own RMD obligation. And here is the trap that catches people like Frank. For IRAs, you can aggregate your RMD. That means if you have 3 traditional IRAs and one of them holds $100,000, another holds $50,000, and a third holds $200,000, you can calculate the total RMD across all 3 and withdraw the full amount from just one account. That is the easy path, but 401ks are different. The IRS does not allow aggregation across 401k plans. If you have a 401k with a former employer and a 401k with your current employer, you must calculate and withdraw the RMD from each plan separately. You cannot take the total from one account and call it done. This is where the math catches people. They assume all retirement accounts follow the same rules. They do not. And that assumption costs people thousands in penalties every single year. Let me give you a real example. A retiree has 2,401 KS from previous employers, one with a balance of $120,000, another with $80,000, and they have a traditional IRA with $300,000. They calculate their total retirement savings as $500,000. They calculate their RMD at roughly $18,000. They take the full $18,000 from their IRA, call it good, and move on with their lives. But they just violated the rules because each 401k needed its own separate withdrawal. The account with $120,000 needed its own RMD of roughly $4,300. The account with $80,000 needed its own RMD of roughly $2,900. Taking nothing from those two accounts means those RMDs were missed. Penalty on the missed 401k RMDs, about $1,800, plus the taxes they will owe when they eventually do withdraw that money, plus the headache of filing Form 5329 with the IRS to explain and potentially request a penalty waiver. This is the kind of error that never makes the news. It never shows up in the cheerful retirement planning newsletters. But it happens every single day to retirees who think they have it under control. Now, let me talk about something that makes this even worse. The tax trap. RMDs are taxed as ordinary income. Every dollar you withdraw from your traditional IRA or 401k as an RMD is added to your adjusted gross income for the year. That means your RMD can push you into a higher tax bracket, but it gets worse than that because your adjusted gross income affects more than just your income tax rate. A higher AGI can cause up to 85% of your Social Security benefits to become taxable. That is money you thought was tax-free suddenly being pulled into the tax net. A higher AGI triggers the Medicare income, related monthly adjustment amount, or RMIA. That means your Medicare Part B and Part D premiums go up, and this is not a small increase. For individuals with modified adjusted gross income above a certain threshold, Medicare premiums can more than double. A higher AGI can also phase out deductions and credits you might otherwise qualify for. So when you miss your RMD and then scramble to take a catch-up distribution, you are not just paying the 25% penalty. You are also potentially paying higher taxes on your Social Security, higher Medicare premiums, reduced deductions. It is a cascade of financial consequences that all start with one missed deadline. And here is the part that makes me angry. The financial industry knows about this. Your plan administrator knows about this. Your advisor knows about this. But nobody is legally required to make sure you take your RMD. Nobody is going to call you and say, "Hey Frank, by the way, April 1st is coming up and you have $130,000 sitting in an old 401k that you forgot about. The system is designed to collect your contributions for decades and then penalize you for the complex withdrawal rules they never fully explained." That is not an accident. That is a feature. Let me walk through the other RMD traps that retirees fall into, because Frank's story is just one version of this nightmare. The inherited IRA trap. If you inherit an IRA from someone who is not your spouse, the Secure Act changed the rules dramatically. Under the old rules, non-spouse beneficiaries could stretch the distributions over their own life expectancy. That allowed the money to keep growing tax, deferred for decades. It was a powerful wealth transfer tool. Under the new rules, most non-spouse beneficiaries must withdraw the entire balance of the inherited IRA within 10 years of the original owner's death. No stretch. No averaging 10 years. And the account must be empty. This is called the 10-year rule, and it trips up a huge number of beneficiaries. A retiree passes away and leaves a $200,000 traditional IRA to their adult daughter. The daughter is 45 years old, in her peak earning years, making $150,000 a year. She inherits the IRA and thinks, "Great, I will just let it grow for a while and withdraw it when I need it." But she has to withdraw the full $200,000 within 10 years. And if she takes it all out in a single lump sum, that $200,000 gets added to her income in 1 year. Her income jumps from $150,000 to $350,000. She gets pushed into the highest tax bracket. She owes nearly $70,000 in federal income tax on that distribution alone, plus state taxes. The 10-year rule does not require annual RMDs if the original owner had already started taking them. And this is where even accountants get confused. There has been back and forth regulation on whether beneficiaries of accounts where the owner died after the RMD start date need to take annual RMDs within the 10-year window. The current IRS guidance issued in 2024 says yes, if the original owner had reached their RMD age, the beneficiary must take annual RMDs in years 1 through 9, then empty the account by year 10. Miss an annual RMD as a beneficiary. Same 25% penalty applies. So not only are you dealing with the grief of losing a loved one, you are suddenly thrust into a complex tax and withdrawal schedule with severe penalties for getting it wrong. It is a setup for mistakes. Let me talk about the Roth confusion. Roth IRAs are the golden child of retirement accounts. You contribute after-tax dollars. The money grows tax-free, and qualified withdrawals are tax-free. And Roth IRAs have no RMDs during the original owner's lifetime. You can let that money sit and grow until the day you die and never be forced to take a single dollar out. But Roth 401ks are different. And this distinction catches a lot of people. A Roth 401k is subject to RMDs, even though the contributions were made with after-tax dollars. The IRS requires you to start taking minimum distributions from your Roth 401k at age 73. This seems contradictory, and frankly, it is. The IRS treats Roth 401k differently from Roth IRAs for historical administrative reasons, and the result is that retirees who have been diligently saving in a Roth 401k for years suddenly get forced to withdraw money they do not need. The fix is simple before you retire. Roll your Roth 401k into a Roth IRA. Once the money is in a Roth IRA, the RMD requirement disappears. You can keep the money invested, let it grow tax-free, and pass it to your heirs without ever being forced to withdraw. But if you do not know about this distinction, you will not make that rollover, and you will end up taking unnecessary taxable distributions. Well, not taxable since Roth withdrawals are tax-free, but unnecessary forced distributions that disrupt your investment plan and reduce the amount you can pass to your heirs. This is a simple fix that so many people miss because nobody tells them. Now let me talk about the beneficiary trap. Most people set their beneficiary designations when they open their retirement account and never think about them again. But life changes. Spouses pass away. Children get married and change their names. New grandchildren are born, divorces happen. If your beneficiary designations are outdated, a few things can go wrong. First, if your named beneficiary has predeceased you and you have not updated the form, the account may pass to your estate instead of directly to your intended heir. When a retirement account passes through an estate, it goes through probate, which is slow, public, and expensive. Your heirs could wait months or years to access the money. Worse, if your will and your beneficiary form conflict, the beneficiary form wins. So you could write a will leaving your IRA to your daughter, but if your ex-spouse is still listed as the beneficiary on the account form, your ex-spouse gets the money. Second, outdated beneficiaries can create RMD confusion for the wrong person. If your spouse was supposed to inherit the account and get spousal rollover treatment, but the beneficiary form is outdated, the account might go to someone who does not qualify for spousal treatment and is stuck with the 10-year rule and mandatory distributions. Reviewing and updating your beneficiary designations is a 5-minute task that can save your heirs thousands of dollars and months of legal headaches. But it is one of those things that everyone knows they should do and almost nobody actually does. Let me now talk about the old account problem. I touched on this earlier, but it deserves its own section because it is one of the most common traps. The average American worker changes jobs 11 or 12 times over their career. Each job might offer a 401k or similar retirement plan. Over the years, that creates a trail of orphaned accounts scattered across different plan administrators, different login portals, different account numbers, and different rules. When you turn 73, the IRS expects you to track down every single one of these accounts, calculate the RMD for each 401k separately and withdraw the correct amount from each one by the deadline. If you have a 401k from a job you left in 1995 at a company that has since been acquired or renamed, the statements might be going to an old address. The login credentials are lost. You might not even remember the account exists. But the IRS remembers, and if that forgotten account has a required minimum distribution of $5,000 that you miss, you owe a penalty of $1,250 on an account you forgot existed. This is not hypothetical. The Department of Labor estimates that there are billions of dollars sitting in forgotten or unclaimed retirement accounts. And the owners of those accounts are aging into the RMD zone every single day. Now, let me give you the action plan, because contrary to how this might sound so far, you can prevent all of these problems. The solutions are straightforward. They just require you to know about them in advance. Step 1. At age 72, start planning. Do not wait until you turn 73. The year before your RMD age kicks in, meet with a tax professional or a fee. Only financial advisor who understands RMD rules. Have them run a projection of what your RMDs will look like, how much tax you will owe, and how it will affect your Social Security and Medicare premiums. Step 2. Consolidate your old retirement accounts. Before RMDs kick in, roll your old 401ks from previous employers into a single traditional IRA. This solves the 401k aggregation problem because IRAs can be aggregated. Instead of tracking 5 different RMDs across 5 different 401k plans, you have one IRA with one RMD calculation. You can withdraw the full amount from any one of your IRAs and meet your obligation. If you have a Roth 401k from a previous employer, roll it into a Roth IRA that eliminates the RMD requirement entirely. Step 3. Set up automatic withdrawals. Most financial institutions allow you to set up periodic automatic RMD withdrawals. You can have the money sent to your bank account monthly, quarterly, or annually. Set it and review it each year, but at least the withdrawal happens on schedule. But here is the warning I mentioned earlier. Automatic withdrawals are not set. It and forget. Your account balance changes every year. The IRS life expectancy tables change. The RMD rules change. You must review your automatic withdrawal amounts annually to make sure you are withdrawing the correct amount. Trusting automation without review is how people accidentally under-withdraw. Step 4. Work with a fiduciary. Not all financial advisors are fiduciaries, which means they are not legally required to act in your best interest. A fiduciary advisor who specializes in retirement distributions will track your RMDs, calculate the amounts, and make sure you do not miss deadlines. This is worth paying for. A good advisor costs a fraction of what a single RMD mistake will cost you. Step 5. Update your beneficiaries. Go through every single retirement account, insurance policy, and payable on death account, and make sure the beneficiary designations are current. This takes one afternoon and could save your heirs years of probate court. Step 6. Understand the inherited IRA rules so you can guide your beneficiaries. If you have a traditional IRA, talk to your adult children about the 10-year rule. Make sure they know that when you pass, they have 10 years to empty the account. And if you were already taking RMDs, they need to take annual RMDs in years 1 through 9. Tell them to work with a tax professional before taking any distributions. A few hours of education now can save them tens of thousands of dollars in penalties later. Step 7. Consider a Roth conversion strategy. If you have years between retirement and when RMDs kick in, say you retire at 65 and do not need to take RMDs until 73, you have an 8-year window. In those 8 years, you can convert portions of your traditional IRA to a Roth IRA. You pay income tax on the converted amount now, but the money grows tax-free going forward, and Roth IRAs have no RMDs. This lowers your future RMD amounts, reduces your taxable income in your 70s, and can save you a fortune in taxes and Medicare premium adjustments. This is a strategy that requires careful planning because you want to convert in low-income years and avoid bumping yourself into higher tax brackets. But for many retirees, a partial Roth conversion in the gap, years between retirement and RMDs, is one of the best financial moves available. Let me wrap this up with a number that should shock you. The IRS collected over $1.5 billion in RMD penalties from 2010 to 2020. $1.5 billion. That is money that came out of the pockets of retirees who made an honest mistake. People like Frank. People who saved their whole lives, played by the rules, and then got blindsided by a technicality they never knew existed. The IRS does waive the penalty in some cases. If you can show that the missed RMD was due to a reasonable error and you are taking steps to correct it, you can file Form 5329 and attach a letter explaining the situation. In many cases, the IRS will reduce the penalty from 25% to 10%. In some cases, they waive it entirely. But that means you have to catch the error, file the form, write the letter, and hope the IRS agent reviewing your case is having a good day. That is not a strategy. That is a prayer. The real strategy is prevention. If you are under the age of 72, run the projection now. Know exactly what your RMDs will look like, how they will affect your taxes, and how they will interact with your Social Security and Medicare. Do not wait until the year you turn 73 to start thinking about this. If you are between 72 and 73, you are in the danger zone. Your first RMD deadline is approaching. Contact your financial institution today. Confirm whether your account is an IRA or a 401k. Confirm whether you need to take separate distributions for each account. Confirm the exact deadline. If you are over 73 and you have never heard of RMDs, call your tax professional immediately. You might have missed distributions going back years. The longer you wait, the worse the penalties get. Frank eventually got his penalty reduced. His accountant filed Form 5329, wrote a detailed letter explaining that Frank had relied on an old advisor who had since retired and never transferred the RMD responsibility. The IRS reduced Frank's penalty from 25% down to 10%. He still paid $8,500. He still owed income tax on the distribution. His Medicare premiums still went up. But at least he did not lose the full $21,000. Frank told me afterward that the worst part was not the money. The worst part was the feeling that he had done everything right for 40 years and then got punished for something he did not even know was a rule. The betrayal, the sense that the system had been waiting for him to slip up. And that is the feeling I want you to avoid. Retirement should be about enjoying the life you built. It should be about time with your grandchildren. Travel, if that is what you love. Hobbies you finally have the time to pursue. It should not be about sweating a tax deadline or scrambling to avoid a penalty that wipes out a year of your Social Security income. The rules are complicated, that is not your fault, but navigating them is your responsibility. The good news is that every single mistake I have talked about today is preventable. With a little planning, a good advisor, and a system of checks and balances, you can meet every RMD requirement, avoid every penalty, and keep more of your money where it belongs, with you. So take the list I just gave you and start working through it this week. Call your accountant, consolidate those old accounts, set up the automatic withdrawals, review your beneficiaries. And if you have not already, find a fiduciary who will watch your back, because the only person who is going to protect your retirement savings is you, and you have worked too hard and too long to let a deadline you never knew about take a quarter of your distribution. That is all for today. Thank you for watching.